Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I need to change that bumper.
Well, I'm waiting for that hard-hitting style. We need to be a little harder hitting today, maybe. I'm Guy Allard, by the way.
And I'm Victor McClure. It says, 60-plus years since I'm so much younger than you.
That's true.
I've only have 31 years of experience. So
that's right.
You have like 46 or something like that?
Actually, it's like 64 combined now, isn't it? We can upgrade that to McClure 2.0.
Yeah. Remember when you were a kid, just 34 years of anything, life. It was an old man,
Oh, yeah, George Carlin, and I recited it on the radio show, back in the early 2000s. There's a whole thing on time and the relevance. When you're 16, and a half, you're 16 and a half, and as you get older, the half certainly drops, and it's, you know what I'm going to pull that up, and we'll talk about it on the next show. It's funny how our perception of time absolutely changes as we get further down the road.
I told you about that Game of Thrones show. That's the funniest thing in the world.
Oh, yeah.
Guy with the Scottish accent.
Oh, yeah.
Nothing F's you more than time.
That's right.
That was a good one. Well, the Dallas Cowboys looked terrible this last week. Remember, our office is here at the Star, so we get all the scoops. I already know the playbook.
For those of you non-patriots that watch the NFL still, I'm just saying.
I am a patriot because I listen to the Cowboys.
Well,
it's the only team to listen.
Yeah, the truth be known, they do stand.
That's right. I want standing. A friend of mine is actually, we were stationed in San Francisco on USS Enterprise. He stayed, I left. I came back to the motherland, Texas.
Did he make a career out of it?
Oh, yeah. He's still I think he's an asbestos cleanup guy because the nuclear power stuff dried up. All the bases closed down.
You said they closed the whole, they just big
everything.
Property, they can't even do anything with it because
Mary
the
Island
asbestos
Shipyard closed down.
Everything's
closed down. But he's a huge Colin Kaepernick fan. And I was like, we're veterans. You know that the kneeler? That's who you're talking about? He goes, yeah, but it's social. And just, get out of here. You can go kneel all you want, just not during my anthem. So he's actually originally from Indiana. Now he's really liberal and loves Colin Kaepernick. He's got pictures of him he posts all the time.
Well, he probably pays California. They must pay a lot of taxes, so.
Yeah. I think the rich people pay a lot of taxes. Everybody else just gets free stuff, I think. I think that's how it works.
Ronald Reagan, which kind of reminds me of socialism, or our political system right now, the worst 9 words in the English language. I'm with the government, and I'm here to help.
Right.
Good luck with that.
Well, like I said, I don't want to talk football, but they should be, when I was a kid, they played the preseason.
Right.
They might have taken out the last half of the last game.
Right.
Remember Jimmy Johnson? He wanted to win every He don't care if it's a game, he wanted to win.
He's very competitive.
Nowadays, they played Dak like 2 series in a whole preseason. Zeke didn't play any.
I did watch Dale Hansen, which if you didn't know him and you didn't live in Texas, you would probably think he hates the Cowboys, right? Because he's always railing on them and Jerry Jones and the whole deal. But he was talking Monday. He goes, well, the lack of attendance in the NFL, I see why it's there, is because they're putting out a poor product. Used to be, just like you said, he goes, used to be everyone would play in preseason. Now they don't play 1 minute in preseason, and it shows. And I'm going, golly, settle down, Dale.
I don't want to say anything because I'm renting from Jerry over here.
That's right.
Jerry, you put a great product out. Don't let guys
coming to you live from the Star, Gridiron Boulevard.
We're getting a couple warnings out now. One from J.P. Morgan, one from Goldman Sachs, warning of a coming bear market. Now, are they always right? No. Are they eventually right?
Yes.
Yeah. That's what I'm telling you is there's no way to know. One of them is saying 2019. One of them is saying 2020. You can find some more probably saying 2018.
I heard a lot Thursday morning. On one of the business shows I watched as I was getting ready, and they were really talking about 2019 in the first quarter. They went into automotive slowing down, housing starts slowing down,
Yep.
And the PEs, as we and Victor, you've been railing on that for a long time, we're way out of kilter. And what happened with the growth that we have, the earnings have come up now some, so they don't make the PEs look quite as bad as they were, but there's still, it's one of those red flags, one of the many that's starting to pop up.
Every single time, this is not one thing we're just making up. Every single time the PE ratio, the Shiller PE ratio, has got to 30, the market has gone down. Either earnings have to double, because your normal is like 14, 15. Remember, it takes 30 years to get your money back, every share of stock you're buying. And you're putting that in perspective, like if you're going to buy this company.
Well, and perspective is the thing, right? We're not telling this to warn the listeners. I've got a dear client that I play poker with often, and he calls me, well, do I need to get out, Guy, now? Do I need to get out? And my answer is no. We've got the income taken care of, and we've got the money that's the safe money is put aside. What he's got in the market for his age is the right percentage, and I tell him that. But if you're out there and you haven't made those adjustments, the stock part of your portfolio has to have grown larger than perhaps you might want it. Now is the perfect time to take some of the profits.
I've never met a person that said it grew too large.
No, or wanted to sell it while it was still
right.
showing any signs of growth whatsoever.
Right. And that, like I said, that reallocation is so necessary but so hard to do as a human.
Counterintuitive?
Wait a minute. I'm going to take money out of the one that made a bunch and put it in the one that didn't make much. That doesn't make sense, right? But that's exactly what diversification and reallocation is. But what they're talking about, Goldman is talking about, they're worried about a full-blown trade war. These are actually just salvos shot across the bows. You know, even though $50 billion seems like a lot, to somebody doing trillions a year in trade is not as much as you might think.
Yeah.
Plus, so they said if it doesn't come to a deal, that's why you'll see the market, when they bring in a new tariff, goes down. When they go have trade talks, we're talking again.
Goes up. That's right. Volatility.
All of that, because no matter what, if goods cost more, people can afford less. They quit spending. As people quit spending, the economy goes down. People quit buying houses, prices go down. Just it's universal economics. So a prolonged trade war is not good. Now, you got the other side of the coin is maybe it does take this kind of hard rhetoric to get a deal done.
And if you don't do it, it'll never happen.
So, but even if it gets done, the market will rally, no question. But it's still overvalued.
Yeah, but keep in mind, too, also, and I'm different. Victor and I, obviously, we have different opinions. We're both right how that works. I'm not sure. But I'm less concerned about the tariffs. Obviously, long term, it's not good. I think it'll hurt the other people, and they'll flinch before we do. But automotive, housing, PE, the basics of our economy, you can see those red flags. And you know, we talked about rebalancing. Just a real quick, easy rule of thumb we've talked about, the rule of 100. Whatever your age is, that's what you should have safe. As the older we get, the bigger the number. Whatever the difference between your age and 100 is what the maximum amount should be that you have at risk. And if that number has changed or come out of kilter because of the growth of the market, now is a perfect time. Secure some of that.
We talk to people every day. And, you know, some people are too conservative. Some people are too aggressive.
All in cash or all.
That's right. They're all in cash or 100%
for years now.
stocks.
That's right.
You don't understand. Yes, I know. I don't understand. I go, but the thing about it is if you're 100% stocks or 100%
How many times have you heard that?
Oh,
you don't understand.
Yeah. We've been doing this 30-something years.
I don't understand
I've seen
yet.
thousands and managed thousands of portfolios. You've done one. I go, not saying that you haven't done a really good job on the one you have.
Right.
But you're flying in the face of every measure there's ever been, every rule of finance that's ever been put out there. Every one of them you're going against to have your opinion that this is going to. Now, don't get me wrong. Remember that confirmation bias? Go on the internet. You'll find some people that agree with you.
Oh, yeah.
You will find. Oh, it's antiquated rules. They don't matter.
Nobel Prize winners, no doubt.
You will find that, okay? But the truth is, remember, if it took 30 years to buy a company, if you're going to buy a small business, nobody in the right mind would pay 30 times 1 year's earnings for it. Nobody would. That's exactly what we do every day when you buy the S&P. Am I telling you not to buy the S&P? No. I own stocks. I like stocks. I manage stocks. Nothing wrong with stocks. But you've got to have your allocations right, and you have to be prepared for a bear market. Because what happened is Goldman Sachs is only predicting about 25% reduction. Now, remember, it made 20-something% in 2017, so it's taken back a year and a half. That's not too bad.
And I heard 20 plus, so we're the same ballpark.
J.P. Morgan saying 20. And so it's different than it was in 2008 or 2000 when it went down 50% each of those times. Because we had a real bad liquidity crisis. People were loaned. They had house loans that they shouldn't have ever had. That's commercial and private.
And
There's so many different things. But now they have more cash. Banks have more cash. Companies have more cash than they've ever had in history, percentage-wise. So it shouldn't be as bad.
And a correction is a good thing to an extent.
The problem is what people do is that's the overall market going down 20. But what people do, there's certain sectors within the market that it's just like having all tech stocks in 1999.
2000,
right? Because that's the ones that kept going up, right? So they kept going up. And so now you might have a concentration of an asset class within your stock portfolio that can make you lose 40, 50, 60%. Because most of them think emerging markets are going to go down 50%. And so those kind of things, you got to be really careful how your allocation is, because what happens is if you didn't do it purposely, since one asset class outgrew the others, it's done it on its own.
That's right.
We got a break coming up, folks, but don't hesitate to call us if you have any financial questions. You'd like to take advantage of our no-cost, no-obligation written retirement plan, Social Security optimization plan. We'd be more than happy to help you. Our number is 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Right before the break, Guy and I were talking about that, the Goldman Sachs and JP Morgan are talking about 20-25% downturn somewhere in 2019 or early 2020.
Oh, be honest. We were trying to predict the correction of the market.
Right. I don't have a Swami's hat on my head, and I cannot predict anything.
But we'll tell you it's coming.
Like I said, the one thing, it's weird. The bear guys are always bearish. Eventually, they're always right? It's 9 years up in a row, so they've been wrong a long time, but eventually they'll be right. But right now, the valuations are such, and the momentum. You've seen the kind of the momentum in the real estate market. Dallas has gone up, crazy. All of a sudden, this last couple quarters, not so much. If the trade tariffs continue or start getting more broad, a trade war is not good for the stock market. I'm just going to tell you that right now. Now, I understand what's trying to happen here. They're trying to see who flinches first, like Guy said. But even if a trade war didn't happen, there's enough triggers with the overvaluation of the market. 20-25%.
Traditional triggers.
I think you should be, that should happen. I don't know when it's going to happen. If I knew that, like I said, I'd be on one of my yachts somewhere with native girls feeding me grapes. There's no way, nobody's going to know. If you talk to an advisor that says he knows or she knows, now you know to run out of that office because they're either crazy or delusional. One or the other. They could believe their own crap. Nobody can tell you where the market's going to go.
But again, don't stress. Be confident in your allocations. If you've sat down with somebody, you've got the three buckets taken care of. Your liquidity is squared away. Your income is squared away. Your market stuff, a few adjustments, gets you back on course, then you're fine.
No, J.P. Morgan came out. They did some extensive modeling to figure out how long the crisis might take, and they're talking about how much we're leveraged,
sure,
the length of the economic expansion, asset price valuations like we've been talking about, the deregulation, which helps financial stuff, and they're still saying about a 20% drop, 35% drop in energy prices, and a 29% drop in metals. Okay?
So if you're in one particular sector, you
That's
could
right.
really get hurt.
Also, a lot of people have been buying emerging markets lately because they're doing real well.
Right.
They think a 48% drop in those. Also, because people are searching for yield, they've been buying more high-yield bonds than they normally would. And the default rate on high-yield bonds in increasing interest rate environment, we've talked about it on the show before.
Many times.
That is a serious, serious thing. You can lose more money on bonds than stocks if you don't have high-quality bonds. I don't care what the company name is next to it. You got to figure out what's the rating of this bond. Anything below investment grade has a huge default rate. In a normal, but if you get rising interest rates, they default a lot.
If you want some good bonds, you probably ought to get some Chicago or Illinois bonds. I hear that Emmanuel now is talking about what's that new equal pay deal for everybody. He's thinking the way out of poverty for Chicago is to give everyone a paycheck.
The Puerto Rico bonds, I heard, are paying like
those are nice.
16-18%. You want some of those?
Those are really good. I forgot about that. That's right.
There's also another thing that people aren't thinking about, and that is, I think rightfully so, by the way, people have moved a lot of times from actively traded funds to passively traded funds, like indexing, like Vanguard and all the ETFs, right?
Take the human error out of the equation.
And long term, that does seem to favor things. That's pretty good option, straight, as long as you have your buckets in order. You're not putting 100% your income buckets, your growth bucket. As long as that's clearly separated. it's not bad. But the problem is when markets dip, when you have actively traded managers, there's a whole ton of money waiting for this dip to buy on the dip. So every dip, that's why it softens or lessens the length of a bear market. It shortens the breadth of a bear market, so they're shorter, they go less down, and they recover faster. But what if everybody's in active funds? They're already and fully invested. There is none of that money on the sidelines. Because used to be 2/3 to 3/4 of all the stock funds were actively managed. Now it's less than 1/3. So there's a lot less money for that kind of stuff. We're not trying to scare people or anything else. We're just telling you there are things, the way the world has changed now,
you need to be up
that you need to have those allocations right. Remember our managed program.
It's easy to do.
Right.
It's easy not to
It
do.
specifically is in every sector of the market. If any sector goes below its moving average, it's automatically out of that sector. Now, is that going to protect you 100%? No. But it does protect you. So you can continue to ride up this market, all right, and get pulled out automatically if something happens. So a buy and hold has worked fantastic for 9 years, but once it gets to a certain point, you're going to have to go tactical is what they call it, or active managed. I think it's more beneficial for the next few till the volatility subsides, or if a dip occurs, then you're back on the buy and hold train, right? I understand the reality. If you're staying something long term, it's going to be okay. But I also understand real life. In other words, if I'm 65 years old and that thing drops 50%, it's going to scare the hell out of me.
Well, and, diversity will also lower your rate of return, right? It doesn't give you the highest rate, but it's supposed to diversify and protect you. So if you're diversified and you buy and hold, you're guaranteed to have Sears and Roebuck, the buggy whip companies. I mean, you're going to have some of those too, but if you're concentrated, that's what gets you in trouble.
And it's like I said, in the 90s, everybody didn't start out with 100% tech stocks or 80% tech stocks.
That's right.
But tech stocks were making 70, 80% returns when the other stocks were making 5%, 10%.
It's foolish not to put all of my money in there.
Don't you think there's going to be more computers next year than
you
here?
dummy? Yeah, of course.
We heard all that stuff. But every time somebody has done something opposite of conventional wisdom, it can work for a while. It will work for a while. But it always comes due at one point or the other. Always, eventually, you're going to get hit. If you put everything you've got in real estate, you know real estate's going to go down at some point. If you're prepared for it, it's okay. Most people aren't. We got a break coming up, folks. But remember, if you have any financial questions, that's what we're here for. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
That's right. Welcome back. Guy's the oldest. I'm not.
That's right.
There you go. We joke a lot. I'm like 2 years younger than Guy. We're both old as hell. That's just the way it is. Yes, the engineer just wagged her head at us.
Do you have anything else you want to talk about? Come on.
All right. I was talking to my son. My oldest is 32, and I've got three little ones.
And a professor in New York.
That's right. The little ones are now becoming older, So, you don't ever think yourself old till your kids are old. Because I remember when I was 32, I thought I knew everything. I'd already most experienced man on the planet.
Remember a couple of months ago when you were walking through New York City and your son was showing you around and you couldn't keep up?
Yeah.
Come on, Dad, what's going on?
Don't ever wear flip-flops if you're going to take a tour in New York.
He's going to blame the flip-flops. When my wife and I went walking with Victor around town, he did the same thing. I shouldn't have wore flip-flops.
My back is all of us were hurting pretty good that day.
Yeah, it was a long day.
Don't
a lot
think
of walking.
Central Park is a lot bigger than you think. Trying to walk that thing around.
We went all the way to Spanish Harlem and back. That was a long walk.
All right. Well, I was talking to my 16-year-old, and we're talking about college majors. Now, I haven't had much luck with my oldest son. He became an art major and blah, blah, blah. When I'm saying about luck, I always tell people, I've never seen, I've seen it, but real rare do you see an engineer without a job. I said, once you use engineering. None of my kids like math like I did. None of them like any of it. So I was going over, and I was looking this up for him, and I had to go over, and it was interesting. What are the top 10 degrees or majors you can have as far as making money? Now, this is just talking about money, because this show is about money.
Surely about
Don't get me wrong, there's nothing wrong with a social worker helping people. That's a noble profession. Not the most money-wise, you're not going to get there, but this is talking about money. Who gets the highest starting salaries? Number 10 was finance. Hey, that's what we do, right?
Hey.
Finance degree. We have 4 new people working here, all have finance degrees, right?
That's right.
So, got them a job here.
One's an engineer.
That's right. Number 9 is civil engineering. Okay. Number 8 is mechanical engineering.
We got a trend going here.
Number 7 is molecular biology. Everything seems to be kind of like in the sciences, right?
Boy, that was way up there, huh?
Number 6, pharmacy, pharmaceuticals, right? To be a pharmacist. What's number 5? Applied mathematics. These are all music to my ears.
Quantum math.
I told you, math is real. Everything else is BS. Math is great. Number 4, health and medical preparatory programs, for nurses, doctors, stuff like that. Number 3, nuclear engineering.
There you go.
The one that got me that I didn't, this one got me. Number 1 is actuarial science, being an actuary. Actuaries are paid quite a bit of money if you're a good actuary.
Again,
but number
math.
2 is the one that confused me. Zoology. Did you ever think in your wildest career that zoology makes a lot of money? Starting salary, $111,000. That shocks me. I had no idea. People working at the zoo probably make a lot of money. Didn't know that.
Which is why I call it zoology. Zoology. How about that?
So think about it. That's why I like this stuff. I've taken half of these. I've taken, right?
Right.
Finance, mechanical engineering, nuclear engineering, actuarial science. Not really. I did take a lot of math, but not really actuary stuff. And zoology. Now I used to be a hunter, so
politician isn't in there. Or?
No, not politician's not in there. But I was trying to talk
attorneys
to my son,
aren't in there.
My son, unlike my older son, unlike my other kids, this one's more money motivated.
Doctors weren't in there.
Well, they said
I'm trying
medical
to think
prep
now
bills.
what wasn't in there. So that's amazing.
Doctors, I think, are part of the medical preparatory stuff. So that would be like number 6. So it's in there. But these are the kind of when kids are going to go to college or they're preparing for college. Now my son's now in the 10th grade. He said, okay, it's real now. I go, it's actually real last year. You better get these grades up. You're not getting anywhere.
That's right. Help me out with a little bit of a
I'm
scholarship.
not some rich guy that's going to give $1 million to get you into a school. It ain't happening.
Call your senator.
That's right. Not going to happen. So we're talking about these different things. And so I said, maybe a lot of our listeners also have children about to go to college. And I thought it might be good that, remember, engineering is always a good fallback. One of our new advisors, Mr. Singh, he said in India that we had 2 choices, medical and non-medical. And I go, really? He goes, yep.
That's right.
Non-medical better be a doctor is what he said. He goes,
better be an engineer.
Right. Better be an engineer.
Medical being
so
the
either
doctor.
medical or an engineer.
That's right.
And he goes, you guys in America, you let them, whatever you think, honey, whatever you dream. Not us. It was medical, non-medical, and I thought that was funny because it is true. Look how many engineers, and doctors.
Yeah, absolutely.
And he goes, yep, that's the way it is. Well, conversely, we talked about a lot of engineering, a lot of medical, finance, and a lot of people might, know that already. Let's look at the 10 lowest paying majors. And I've hired a bunch of these people before, so I'm kind of familiar with this one.
Okay, there you go.
Library science is the number 10.
I got a friend that's got a PhD in that.
Doesn't it seem like, I guess that would be library science, not high paying, right?
Teacher.
Nothing wrong with the librarian. Nothing wrong with it. Number 9, interdisciplinary and multidisciplinary studies. Whatever the hell that is. All right? We'll go over that more when we come to a break. Remember, if you have any financial questions, don't hesitate to call us, 972-715-2424. You always go to our website, ilovemyretirement.com. There's some great videos and some white papers. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the Common Sense Investing Show. We've been on the air a long time. We had a brief hiatus there, but a lot of people don't know we're an independent company. We do everything: stocks, bonds, annuities, insurance, everything you can think of. Guy and I both have never had a customer complaint in 30-plus years each, and that's tough when you do stocks. We've got more credentials than anybody I know. So, like I said, if you have any questions, call us. That's what we're here for, 972-715-2424. We talked about the last segment, the best paying majors. Now we're going to talk about the least paying majors. We went through the first couple.
That's right.
Library sciences was number 10. Interdisciplinary and multidisciplinary studies is number 9.
Nice.
Whatever that is.
Yeah.
Number 8, drama and theater arts. Number 7, educational psychology. These are the lowest paying majors. Number 6, human services and community organization. Now, wait a minute. Obama was a community organizer, and he ends up worth a lot of money now, isn't he?
He's worth a lot of money.
Number 5, visual and performing arts. Are you starting to see a pattern here?
I am.
Most of the ones that pay the most are engineering, medical, stuff like that. Most of the ones are the arts that pay the less. Visual and performing arts.
But they are the most fulfilling.
That's right. Number 4, cosmetology and culinary arts. Every time I watch one of those chef shows, I'm like, I can't work for some guy yelling and cussing me all the time.
Oh,
That's really happening
screaming in the kitchen.
these chefs. I said, I can't believe that chef ain't got a hatchet in his head or something, yelling at people all the time. Number 3, lowest paying majors, clinical psychology. Somebody told me this when I was in school. They said, psychology degree on its own, you can't do anything with it. I go, what if you're a big counselor or something like that? He goes, it's really tough to do anything with it. They just don't pay a lot. I was like, oh, that stinks.
It's like most professions. You have the upper echelon that make money and a whole lot that don't.
Number 2, composition and speech.
Nice.
And number 1, lowest paying job, miscellaneous fine arts.
So it's another fine arts deal.
Everything's to do with art. Art is beautiful. The world is better with it. But apparently it doesn't pay anything.
And it's a fulfilling career.
Absolutely.
All right. You guys have heard us talk about, we may have gone over this case before. If so, it'll be good for to go over it again. You always hear us talking about the retirement analyzer and putting your information in and the difference that it can make for people once we get them to sit down and you actually know when your money is going to run out, how long, what your budget is. We're working on a case right now. I'm just going to give you the basics. I'm not going to go through all of the stuff, but just to give you the basics, this case, this fellow who's single came to us with about $2.6 million sitting in cash. Didn't want much risk. He needed $6,700 a month in income, $2,000 of which he's already got coming in from Social Security, right?
Like $80,000 a year, okay.
So he's only got $4,700 that he needs to make on $2.6 million. No problem, right?
Right.
Ran it at 2% because he wants it all safe. He's not taking a lot of risk. He runs out of money at 89, 0 left. Now, that's not the bad news. The bad news is that $6,700 is now $12,000 a month in expenses, and his $2,000 from Social Security has grown to $32,000. $12,000 in expenses, $3,200 in income, and no cash at 89.
And that's why people are doing I know some listeners have their calculators out. They're like, well, how can somebody run out $2,000? It's inflation. There's no way your water bill is going to be less 20 years from now,
right.
or your electric bill, or anything else out there. Remember, medical inflation has been 7% a year. That's 20 years, 4 times, 400% increase 20 years.
Absolutely.
And that doesn't seem to be going anywhere except up.
That's right. Now, what we were able to do with this is we just massage the numbers, we play with it, we model it, we see what we need to do. Again, our goal is to take care of his income, right? It allows the other money to grow. I mean, this is our principle. We talk about it with you guys all the time. So what we did is we took $850,000 and put it in a guaranteed income producer to make sure they've got their income. We left $1.8 million in cash at retirement if he didn't want it in the market. So at 89, instead of being broke, he now has $2 million cash. The bills are still $12,000, right? But guess what? The income is $12,000. Again,
what you're doing is you're getting an increasing income stream to keep up with inflation.
That's right.
Instead of so many out there are advocating for a high level start. It starts a little higher, but it never goes up. This is one of the beauties showing you how much better it is to get one that goes up with inflation. Because if it does that, because I'm telling you right now, $5,000 or $6,000 a month is a lot of money now. It's not going to be a lot of money 20 years from now. If you're, right now, I remember when we were single in Dallas, years ago, right? A really nice apartment. I had like a 1,500 square foot apartment. Really nice. It was like $800 a month.
Yeah, not anymore, right?
No. It was like $3,000, $2,500 a month now. Everything goes up, and if you don't account for it, it's going to bite you. Because what people do is they do simple math in their head.
That's where I was going to go.
I got $1 million. I need $50,000 a year. It's going to take me 20 years to run out. They have completely ignored inflation, sequence of returns risk. They've ignored a lot of different things, but simply it should be right. Well,
when you first heard us talk about this, you thought he was fine, probably.
Right. So it should be right, but you forgot inflation.
That's right.
And we're not talking now. By the way, we're not one of those advisors that try to scare you with inflation. You know the number we use is 2.5%.
Yeah.
2.5% is only that's how much those bills will go up at 2.5%. And so I'm not one of those people that are going to rely. Social Security is supposed to go up with inflation, except a few years ago, like 3 or 4 years, they took out energy, one of the biggest parts of inflation there is,
to keep the CPI down.
To keep it down, right?
That's right.
And so I'm not confident that my Social Security is going to keep up with it. So I'm going to buy an income stream that will keep up with it, regardless of what the government does.
Guaranteed income.
That's
stream.
right. And so that's the kind of thing, when you do that, when you put a program together and you can take like a third of this person's money and guarantee their lifestyle until they die, no matter what they do, they will never go broke. Instead, he was going to go broke just by keeping it in the money market just because of inflation. He hadn't accounted for inflation. But we do these plans all day long. We have the most comprehensive retirement planning software there is. We're more than happy. There's no cost, no obligation. Give us a call if you'd like to take advantage of it. 972-715-2424. Again, 972-715-2424. Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Guy and I heard another commercial from the Bank on Yourself people, I think they're called. It beats the pants out of your 401k, IRA, blah, blah. All right. 401k IRAs are not investments.
Nope.
They're just a holding vehicle.
It's title
so
of
how
your
can
account.
it beat? They're trying to play on fear and all that kind of stuff. And they're selling a life insurance policy. That's what they're selling.
Which most investments that have high projected returns do it off of a high number that the market's going to average, and that's the problem with those. They're banking on the market making 8% a year or something.
Right. Here's what the illustrations we do, because everybody does illustrations, including us. But what we concentrate on, the low numbers.
That's right.
Because if you can live and the low numbers will work for you, when it makes average or high numbers, you're going to be really happy. The problem is people plan on 10% a year in the market when it's only made 5 this century, and then they're caught,
Flat-footed.
Right.
I'm not going to go through the numbers because then, in effect, I would be using the numbers. But Victor and I use a range, the lowest to the highest, which is a very modest range.
Right.
Our investments actually, for the most part, have produced twice the highest number, almost, to the clients. So they've done extremely well, but we don't even talk about those. We give them a modest range. It's the old deal. If you do better, you're a hero. But if you tell them a high number and even do a 0.5% less, you didn't tell them the truth.
Within 10 days, somebody called me with $2 million, and they said, I need, $100,000 a year.
Yeah.
And there's no way you can tell me that I'm not going to be able to get that with this, and I'll still have my 200 will grow.
Right.
And I said, well, the only thing you got to worry about is that sequence of returns risk. I don't care what the risk is. I go, all right, I'm going to give you one brief example. We talked about it before. Market goes down 50% like it has twice this century. Okay? You're taking out $100,000 a year.
Now you got $1 million.
So you got $1 million, but you need your 100 to live on, right? So you got $900,000. I don't care what it makes for the next 5 years, because every 5 years you got to take out another 100, right? That was your expenses.
Every year.
It is, every year. It is a death spiral. You cannot recover. I don't care, because what people are doing is taking averages. If the market averaged 5 and I'm taking out 4, I'm fine. Unless the sequence of returns risk. You cannot take funds out of something with a fluctuating principal, because it will not work. Eventually, it will catch you, and it's called the death spiral, because there's no way to get out of it. Think about it. 1 year, the $2 million is down to $900,000, right? Market just stays flat, it's down to $800,000. If it goes up 20%, it's still $1 million. There's no way to recover that $1 million. You'll likely go broke. We saw it in the S&P, which beats 90% of most investors. If you're 100% stocks, you still went broke, taking out 6% a year this century.
That's right.
Completely broke.
Started with $1 million.
Yeah, even though the market made 5. You're thinking, well, I'm only taking off 1% a year. How did it go broke?
And 6.
Sequence of returns risk is why it went broke. Because you can't take long averages, because that doesn't account for the day-to-day losses and gains.
And the old adage is you don't chop the tree down to harvest the fruit.
You've got to be careful with this stuff. That's why your bucket strategy is so important. You need an income bucket to pay your expenses, not taking expenses out of your growth bucket. Trying to commingle these buckets is where people get sideways. In other words, they might like stocks more than anything else. So they're going to try to get some dividend-paying stocks and maybe some, that kind of stuff in their stock piece. They're merging the two. Still, the sequence of returns will destroy your portfolio if you take a large loss, especially in the first 5 years of retirement. Now, we've had 9 up years in a row. If you're going to retire soon, what's it more likely to take a large loss in the next 5 years?
The other thing I'd add briefly, just to tag on to that, when you're shopping for something to do, do not shop returns. I talked to a guy this week. Well, what type of return are you offering? What that lends itself to is the guy that's going to tell you he can average 12 or 15% a year, which he can't, or even 10. We go, I want to go with that guy, which this guy has. And how's it doing? It's not doing very well, but I'm going to give him another 6 months. And it's his third person that he's dealt with since he's talked with us.
Cannot chase returns.
Don't chase the number.
What you want is you want somebody that's giving you a really good low number. If their worst case is good, you're probably better off.
Absolutely.
It's a weird thing because you're like, wait a minute, one guy's saying I'm going to get 12%, we got 5.
I want 12. What do you think? I'm stupid?
Last time I looked at one, it said 16% a year. This is why I'm going with this. I said, well, send it to me. Send it to me. It started in June of 2009. What happened in March or April of 2009? It hit the bottom and started going straight up. So this person has conveniently forgotten any of the down years and took the immediately, like he got in that market 2 months after it bottomed out, which is impossible.
And if you still think we're wrong and you should chase returns, I challenge you to go online and get Money Magazine 1990, 95, 2000, and look up the top 10 mutual funds because you were chasing returns and you wanted to be in the top ones and see where they are now.
Who was the fastest growing mutual fund company in the 90s?
Magellan?
Janus.
Oh, Janus, that's right.
I did commercials, I did shows, and I did seminars on that stuff. If you guys have been around that long, I was doing it then. I said, at Janus at that point, there was one woman that had 10 years experience. And I'm like, this is one of the biggest mutual funds. I go,
that's right.
This can't be right.
Right.
Yeah, 10 years, 20 years, 15 years experience. I was like, this got to be a disaster. How much you hear about Janus funds anymore?
Zero.
And they were, like I said, everybody had to have a Janus funds because those returns, they were going off tech stocks, and a lot of tech we're doing something. No, I'm not. I'm just bashing them because that was an industry standard at the time in the 90s.
It's just a symptom of what the problem is.
And so there's a lot of things, and that's why even if you think you're okay with your portfolio, if you never listen to another thing I say, get a second opinion. People's perspectives are different depending, because what do you do? When you want to get growth when you're 30, you want growth. When you're older, you want protection and income. That's what we do. Call us at 972-715-2424. Again, 972-715-2424, or you can go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always, always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.